They tell you compound interest is the secret to wealth. They show you neat charts, famous quotes, and one name, Warren Buffett. But they forget one thing: Buffett didn't start from zero. He wasn't just patient, he was powerful. If you think putting a few bucks a month into the market will make you a millionaire, you're not being told the whole story. The truth? Compound interest is not the path, it's the multiplier. But you need something to multiply first. Let's rewind. Buffett is retiring at 94. The media says he's the king of compound interest, the living proof it works. But by age 32, he had over $1 million. That's more than $9 million in today's dollars. Not from cutting lattes, not from 7% annual returns, from raising capital, from managing money, from taking control. Here's what most people miss. Compound interest is made of three parts: your capital, your return rate, and your time. Everyone focuses on the last two. But the most important, the real engine, is capital. Without it, compound interest is just math on a whiteboard. If you have nothing, you multiply nothing. If you save $50 a month for 40 years at 10%, you'll end up with around $300,000. Sounds nice. Sure, but what if an emergency forces you to pull out early? What if the market drops 30% the year you retire? Suddenly, that safe plan looks fragile. Now let's compare. Two people earn 10% returns. One starts with $10,000, the other with $200,000. After 1 year, the first earns $1,000. The second, $20,000. Same skill, same return, but one result can change your life. The other barely pays a vacation. That's the dark side of compounding. It amplifies what you already have. If you start with little, it magnifies little. And what about losses? Compounding doesn't protect you. It exposes you. Gain 100%, then lose 50%, you're back to zero. The math isn't symmetrical. A 50% loss needs a 100% gain to break even. And what's easier to find? A huge win or a crash that cuts your account in half? In real markets, stocks, crypto, funds, losses are more common than dream returns. Buffett didn't just get lucky. He played a different game. He raised money, managed portfolios, bought companies, used insurance floats to invest with someone else's money. He wasn't a passive investor. He was a capital machine. He didn't wait 40 years. He built fast, then let compounding kick in once he had momentum. That's not magic, that's structure. Most financial advice says, cut expenses, invest early, wait. But how many retirees do you know who followed that, yet still worry about money? Why? Because they never had enough to start with. Compound interest can't rescue you from a weak foundation. It's a bonus, not a strategy. If you're in your 20s or 30s, here's the truth: 7% gains won't change your life. Skills will. Income growth will. Owning something will. You are your highest return asset. Build your value, your cash flow, your leverage, then invest. That's when compounding turns powerful. Let's talk about Buffett again. By 26, he was managing $100,000 from investors. By 32, he turned it into $1 million. He didn't wait for time to do the work, he multiplied through action. He made money move. He didn't sit back and hope. He directed capital like an architect directs steel and concrete. And when he bought Berkshire Hathaway, it wasn't for the textile business. It was a shell, a vessel. He used it to acquire insurance firms, and with their steady cash flow, he bought more assets. The float gave him capital even when his investments lost value. He wasn't depending on growth. He engineered it. This is the difference between investing and owning, between hoping and building, between following a plan and designing one. If you're just putting money into index funds and hoping it compounds, understand it can, but slowly. And only if nothing breaks. If your income stagnates, if emergencies happen, if inflation bites, you'll need more than hope. Compound interest works best when you already have assets, when you already have income, when you can afford to leave money untouched for decades. That's not most people, especially not in the beginning. That's why the wealthy accelerate first. They build, then they invest. So, what should you do? Don't chase a 7% return when you could chase a 70% income jump. Don't focus on cutting $5 habits. Focus on creating $5,000 solutions. Don't wait for compound interest to save you. Build a machine that doesn't need saving. Learn valuable skills. Start a business. Sell something. Build leverage. Use the internet. Network. Then, and only then, begin compounding. Because compounding a weak base takes decades, but compounding a strong one takes years. Yes, Buffett's wealth exploded after 60, but by then, he already had hundreds of millions. He wasn't proving compound interest creates wealth from nothing. He was showing what happens when compounding has real fuel to burn. Ask yourself, do you want to grow slowly and safely for 40 years? Or build fast, then grow powerfully? The choice isn't between risk and safety. It's between low-impact strategies and ones that can truly change your life. Compound interest is real, but it's not magic. It's not instant. And it's not the first step. Your job isn't to save pennies, it's to grow dollars. Because when you have enough capital, enough skill, and enough control, then compounding becomes what it was always meant to be. A reward for the builders, not the dreamers.